the stock market falls 80, maybe gold falls 40 or 50%. Silver could fall the whole amount. I don't know. Then you're right. Once you get 2/3 of the way through the bust, you're going to start seeing, I think gold will be the first thing to move up. Gold goes to, I'll use my 3,000 target, although I think it's probably low. It could come back to 2,000. It could fall by a third, let's say. I don't think it falls much below that. So if it goes to 3,500, maybe it still comes back here. But from there, to me, I think the end of the decade, when inflation's soaring towards 25%, or is it near there, I think you could be looking at 20,000 gold.
Gold prices remained steady at nearly $2,455 during the early Asian session on Friday, fluctuating between minor gains and losses as the U.S. dollar consolidates. DavidHunter, a well-known macroeconomist and investment strategist, is recognized for his contrarian views and bold market predictions. Hunter's bust and boom thesis on global markets has garnered significant attention. He predicts that gold could surge to $3,000 before retreating to around $2,000. By the end of the decade, when he expects inflation to skyrocket to 25%, Hunter forecasts that gold prices could reach $20,000. He believes gold will be one of the first assets to recover as investors begin to anticipate future inflationary pressures. In the meantime, geopolitical tensions, particularly in the Middle East, could continue to support gold, which is traditionally viewed as a safe haven asset during times of uncertainty. Hunter is equally bullish on silver. He predicts that silver might drop to $75 before potentially skyrocketing to $500 when gold reaches $20,000. This suggests a possible 10-fold increase for gold, and a 20-fold increase for silver from their current lows. On Friday, silver met with some selling pressure, erasing part of the previous day's gains that brought it close to the $28.50 mark, a nearly 2-week high. The white metal is trading around the $28.10 to $28.15 region, down over 0.70% for the day during the early European session. Adding to the bullish sentiment, a research article from J.P. Morgan noted that gold prices continue to reach all-time highs, driven by a mix of factors, including heightened geopolitical risks, expectations of a potential Fed rate cut, and increased central bank buying. The article emphasized a strong bullish medium-term outlook for gold and silver through 2024 and into the first half of 2025, highlighting the importance of timing the market entry. Please tune in for our exploration of DavidHunter's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
I think will fall. The equity markets, I'm using 80%. Gold and silver. Silver could fall very hard because it's more cyclical. Gold, I would guess, maybe it falls. If the stock market falls 80, maybe gold falls 40 or 50%. Silver could fall the whole amount. I don't know. I don't have targets, but I just think that for sure they're going to fall hard. But then you're right. Once you get 2/3 of the way through the bust, you're going to start seeing, I think gold will be the first thing to move up because people start understanding all this money is going to create inflation down the road. You'll get a sense at some point that, let's say gold goes to, I'll use my 3,000 target, although I think it's probably low. It could come back to 2,000. It could fall by a third, let's say. I don't think it falls much below that. So if it goes to 3,500, maybe it still comes back here. But from there, to me, I think the end of the decade, when inflation's soaring towards 25%, or is it near there, I think you could be looking at 20,000 gold. So you've got possibly a 10-fold move from the bottom of the bust, from the gold's bottom in the bust to there. And silver, I think, can, who knows where it falls to. Let's say it goes to, if I'm right about, we've got just to make the 75. So you got to get there first to know where it's going to go, but down to. But let's say it goes to 75. I mean, it could easily fall back to, in where we are now, maybe even lower. But from there, I have a target of 500 on silver. One gold is 20,000, silver will be 500. So, you are looking again at something that's a huge move. It might go, that'd be obviously, as we know, in bull markets, silver often outperforms gold by a lot. And I think that's what you'll see in that too. So one might go up 10-fold, the other might go up 20-fold. So I do think there's a huge cycle after this one, but you can't, as I say, you don't want to be standing on the south rim of the Grand Canyon thinking you can walk straight across. There's that canyon in between. So for those that say, well, I'm a buy and holder, again, physical metals are a different story. People may want to just hold on to them, but in the markets, you probably are not going to feel very good about saying I'm a buy and holder and I'm just going to sit here. I think there's going to be a lot of pain there that these things aren't going to eliminate for you.
DavidHunter has voiced significant concerns regarding the Federal Reserve's current financial system management approach. Hunter predicts that the Fed may ultimately need to inject up to $20 trillion into the financial system, 4 times larger than the interventions seen during the 2020 and 2021 economic crisis. The Wall Street Bank has also echoed concerns about the Fed's balance sheet strategy. It has previously suggested that the Federal Reserve would likely halt its balance sheet reduction before reserves reach a somewhat above ample level, especially if a recession occurs. This cautious approach highlights the delicate balance the Fed must strike between reducing its balance sheet and ensuring sufficient reserves to support the economy. During a July 2023 press conference, Fed Chair Powell indicated that when economic conditions are stable and the Fed merely normalizes interest rates, the balance sheet reduction could continue even as policy rates decrease. However, recent data reflects a cautious approach, with the Fed's balance sheet experiencing a reduction of approximately $27 billion in the week ending July 31st. This reduction included $10 billion in treasuries and $14 billion in mortgage-backed securities being allowed to roll off, signaling the Fed's ongoing efforts to manage its holdings while navigating an uncertain economic landscape. Let's get back to the interview.
I think one of the stories, the reason I'm calling for a bust, the bust refers to the economy and the financial system, and the bear refers to the market that accompanies that, the 80% down. The Fed will react to both, but particularly the bust. But I think they'll react slowly because keep in mind, Powell has said for many years now that we're not going back to the policies of the last decade. We are not going to do. He's almost taught. I think he said we don't want to do QE again. We're not going to see, and we're certainly not going to see the magnitude of QE that we saw in 2020 or prior. So he doesn't want to go back to zero interest rate policy. He doesn't want. What he doesn't realize, and that's a sign that he doesn't realize what I think is coming. If I'm right, this is the biggest, fastest downturn we've seen, in the post-World War II era. So bigger than 2007, 8, more, greater magnitude than 2007, 8, bigger, obviously, than 2020. It's easy to talk about, well, we're not going to go back there. I guarantee you, if we are getting a free-falling system, and it will be weak economy, unemployment maybe to double digits, in this country, but accompanied by major bank failures across the world. As I say, the U.S. got hit so hard in 2007, 8, or 2008, 9. We were kind of the big story of 2008, 9 in terms of banking crisis. I think next time it may be centered in Europe. It may be centered in, Europe, Canada, Australia, and some of the places that didn't get hit as hard then will be hit, but we may not be the lead story this time. We meaning the U.S. banks, but it's going to be a worldwide free fall in the banking system, in the financial system. They're going to be slow to react because they won't see the magnitude of it initially, and because it's going to require so much more than previous cycles. So it's funny that he's saying we're not going back there. The truth is, before this is over, they're going back there on steroids. I mean, it's going to be bigger than 2008, 9, or the money that was required in 2020. What I think you could see is as much as 20 trillion coming out of the Fed. That's what I think it's going to take to stabilize the system. And of course, every other central bank will be doing similar, proportionally similar. They obviously are different sizes, but so you are going to see, we put out 5 trillion. The balance sheet, Fed's balance sheet expanded by 5 trillion in 2020, 2021. This time we'll see 4 times that is what I'm estimating. But to get there, if his mindset right now is we're not even going to see QE again, or we don't want to do QE again, and it's going to go to four times what we did, then he's not going to get there in a quick fashion, So he might say, well, reluctantly, I'm going to have to put a couple trillion in because things are blowing up or things don't look quite right. It's going to take him several efforts to get to a right size policy. Mm-hmm. It might be, two, the next time four, the next time eight, but it's going to take a while before he stabilizes the system.
As the Federal Reserve navigates the complex landscape of economic management, concerns about its potential need for larger interventions loom. The central bank's recent balance sheet adjustments reflect a cautious approach, but questions remain about whether these measures will be sufficient to address future crises. With the possibility of more significant financial injections, the Fed's strategy and timing will be critical in determining the economic outcomes. How prepared is the Federal Reserve to respond swiftly and effectively to an emerging crisis? And what impact might this have on the broader economy? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.